Hey, what's going on? I'm Ron Sneller, registered financial consultant, and thank you for taking the time to attend the Infinite Banking Masterclass. You know, every day I talk to business owners, investors, and families that are really concerned with what's happening in this country. Everything from the political and economic climate to what's happening with interest rates and what's happening with the stock market. And to be sure, there's a lot to be concerned about. And nobody can predict the future, but there is a lot of uncertainty ahead. And so we want to do the best that we can to plan for that uncertainty because there are strategies that you can use to insulate your savings from all of this uncertainty and from all of the market manipulations. And really, that's what the infinite banking strategy is all about. And we'll be talking about that here today. It's really an easy to understand and easy to learn cash flow strategy, and it will help you take back control of your capital while giving you more leverage and liquidity throughout your working years. And really, this is a foundational concept that I believe that everyone can build their financial house upon, including myself and what I've done with my own family. And I really think it can serve as a solid financial foundation to allow you to maximize the efficiency of all of your other investments while minimizing that uncertainty and minimizing the volatility. So, what if there was a way where you could protect your capital and safely grow it and spend it all at the same time? And I'm telling you that there is. And that's what the infinite banking system is all about. Again, the same strategy that I've built my family's financial foundation upon. In fact, this is the strategy that the wealthiest families in America have used for generations to protect and grow their wealth. Families like the Rothschilds and the Rockefellers, they've used this strategy to help them create their empires. Businessmen like Walt Disney, Ray Kroc, J.C. Penney, they've all utilized this strategy to help them create their empires. But you don't need their kind of wealth to benefit from this strategy. But we do want to talk about maximizing your wealth. And so we really need to start by discussing how a huge key to all of this, a huge key to achieving financial independence is finding ways to minimize the transfer of wealth out of your personal economy and find out how we can recapture it and put it back to work for you. And this all starts with how you spend your money and with how you save your money. And there's really three ways that you can go about doing that. So let's take a look. All right. So again, three different ways you can run your household spending and investing. For the typical American, they are borrowing to pay for large expenses for their lifestyle or for capital for their business. We call these people debtors. They work to spend and they don't have capital working for them because they can't save. Now, when expenses come up, they borrow money and they slowly repay those loans using future income. The debtors, or these borrowers, they're always paying interest. Let's take a look at this again. You see this, they have this continued cycle of borrowing and repaying, and this continues and continues throughout the course of their lives, but they're always working just to get their heads above water. They're always working just to get back to zero. You see, the debtors have obligated the majority of their future paychecks to somebody else. They have become someone else's asset. They've become the bank's asset. And if you're trying to build wealth, that is a terrible place to be. Now, the traditional way that maybe our grandparents or our parents handled large expenses is that they saved up their money. When they have a large expense that comes up, what they do is they empty their savings to pay for it. Or what I say is they drain their tank. Now, as savers go through their lives, they're continuously going through a cycle of filling their tank and then draining their tank, and refilling their tank and then draining their tank. Every time they have a big expense, their tank is drained. And on the wealth curve, they return back to zero. And when you think about it, in this comparison, they're really no better off than the debtor, because at the end of the day, on that wealth curve, they both wind up at zero. And that brings us to the third way of spending and investing, and this is to be a wealth creator. These are people who save as much of their money as possible. And then when they need to make a large purchase, instead of spending their cash and draining their tank, they simply access their capital by collateralizing against their growing wealth. When you look at the screen here, this is the key. The key is to borrow against an appreciating asset, thus not interrupting the compounding power of interest. This is the secret. This is the key. And this is what the wealthiest families have done in America for generations. When you use this system, you recapture the entire purchase price of whatever you're buying by paying it back to yourself, but you're also recapturing the interest cost that you normally would have transferred away to third-party banks. So let's take a look at this again. You're building up your account. You want to build toward maybe $1 million, right? But you can actually use the money as it's still growing. When you purchase a car or college tuition or a boat, you borrow against your asset. You simply take the same payment that you would have made to a third-party bank and pay it back to your policy as your policy is still growing. Now, that money that the typical person is transferring out of their personal economy by draining their tank and paying cash for purchases, see, you're recapturing that money. Plus, the important thing is recapturing the wealth potential of all of that future compounding interest. Let's take a look at why that's so important, right? Let's go back to the savers. Remember, each time they pay cash for a purchase, they're draining their tank and they're killing their power of compounding, right? And so what that means is they have to start all over. But what they're also doing, they're transferring their wealth to somebody else, right? If they're buying a $100,000 vehicle, for example, if they pay cash, they're transferring the $100,000 to a dealership. But it's not just $100,000 that they're transferring. It's also they're transferring the future compounding potential of that wealth to somebody else as well, right? And Albert Einstein said the eighth wonder of the world is compound interest, but he was only half right. The true wonder is uninterrupted compound interest, if you will just let that power go to work for you over the long term. But most people don't do that because they've been told that they need to avoid debt and they need to pay cash for all their purchases. So even though they're well-intentioned, they constantly interrupt the power of compounding. Now think of the opportunity cost on that. Let's check out the math on that. So let's compare the infinite banking concept to spending cash, or what I like to call the Dave Ramsey way, because he tells you that you use a cash envelope system if you need to, save up cash and always have cash for purchases. But here's the problem, that Dave Ramsey will never share the opportunity cost associated with the Dave Ramsey way. Now check this out. In this example, we'll show someone who is saving $1,000 per month or $12,000 per year, and we'll use a 6% interest rate. And we'll say that at the end of year 6, they've accumulated about $85,000 and they want to spend that money. Let's say they buy a car, okay? Now, if they were to spend their own money, they would have to drain their tank and then start saving that $1,000 per month all over again, only to drain the tank again when they want to make another purchase and then keep repeating the cycle. The red chart shows what happens to your wealth when you're constantly interrupting the power of compounding. Now, the green chart that we're putting up shows what happens to the same amount of money saved at the same 6% interest rate if it simply enjoys uninterrupted compound interest over the long term. So if you were to add that $1,000 a month to your cash reserves and let it enjoy uninterrupted compound interest, at the end of 30 years, if growing just at a conservative 6%, it would have grown to over $1 million. Over $1 million. But by draining your tank every 6 years and interrupting the compounding power of the wealth that you're saving, this actually turns out to be a $1 million mistake. And that's the question that I have for folks is, can you afford to make a $1 million mistake? I sure as heck can't, right? So the big lesson that we teach here is this, is that you actually finance everything that you buy. You either, even if you pay cash, because you either finance it with interest that you pay to the bank or you finance it with opportunity cost, interest that you could have earned but didn't because you transferred your savings and the compound interest potential to somebody else. Now, I want to kind of stop here and say that this is not a get-rich-quick scheme. Infinite banking is not get-rich-quick. This is about long-term wealth building. As you can see on the chart over on the left-hand side, in the short term, infinite banking, it doesn't make that much difference. What I tell people is it's that slight edge. But when you take that slight edge and compound it over time, in this example, compound it over 30 years, it makes all of the difference, right? In this example, $1 million worth. Now, do we recommend that you borrow against your policy and go blow it in Vegas? No, absolutely not. But another thing that you can do in addition to financing lifestyle purchases is to deploy that capital into productive assets like buying real estate, investing in a business, or even buying into the stock market after a big correction. And in fact, this is how many people have actually gotten wealthy. They protect and safely grow their capital, keep control over it, and then they make a killing during downturns. Because during recessions, when everyone else is panicking and selling off their stocks and real estate in a fire sale, the wealthy swoop in and buy those assets for cheap but they're only able to do it because they have access to capital. So in this example, they would simply borrow against their policy and purchase real estate when real estate's cheap, or purchase stocks when the stock market is cheap. Unbelievable stuff you're able to do right here, guys. And it's like, when would you want to get started on something like this? Before the next downturn or after, right? Or if you're keeping cash and it's just rotting away in the bank, why? Isn't this a much better strategy? All right, let's transition a little bit here. Switching gears, you're starting to kind of understand this strategy, and when you're using it, you're never interrupting the compound interest potential, and you're not giving up control of your money. You can still access the money and utilize it for outside opportunities and other investments, and that can create tremendous wealth over time. However, you are borrowing against an appreciating asset, and many people have been conditioned that all forms of debt are bad. So maybe you hear the word loan and you just cringe. And you might be thinking, won't this just make me one of those debtors? Now, the fact of the matter is there are forms of good debt where you can pay interest to turn around and make more interest. And that's exactly what the banks do, isn't it? Like when you deposit your money with the bank, let's say it's just a savings account and they're paying you 1%. And what they're doing is they're turning around and they're taking your money and they're loaning it back out on an auto loan and maybe charging 5%, right? Or if you have it in a high yield or money market type account, maybe they're paying you 3%. They're taking your money, they're loaning it back out maybe on a credit card and charging 10%. So that's what banks do. Like they're willing to pay a little bit of interest to turn around and make more interest. And that's kind of what the infinite banking concept is all about. It's taking back control of that banking function in your life where you say, hey, we don't mind paying a little bit of interest so we can turn around and make a lot more interest. And in fact, when you understand and begin to think like the banks, you'll actually realize that you can make a ton of profit, even if the interest rate on your loan is the same as the interest rate that you're getting on your savings. Well, how can that possibly be? Like if my policy is earning 6%, or if it's earning 5% and I'm borrowing against it at 5%, like, wouldn't that be a wash? Wouldn't it just be zero? I wouldn't make any money, right? Like, what's the point? No. How can this possibly be that you can come out way ahead? And it has everything to do with the difference with the math on compounding interest versus interest on amortized loans. Let's take a look here at another example, guys. Let's say that you saved up $50,000, and we'll just say that, you're going to buy cars over time, every 5 years, whatever, $50,000, right? So we saved up $50,000 at 6% interest. We'll just kind of take a look over the course of 25 years, right? And you'll see like during that time that you're going to end up paying $46,000 of interest. But what you want to notice is that with each passing year, the principal is reduced as you make payments. And so each subsequent year, the interest calculation is reduced as well. Now, if you reverse the scenario, you still have the $50,000 because you didn't pay cash for the car. You borrowed against your policy, so it's still growing, okay? Now, let's say it's earning that same 6% interest rate. At the end, it's $165,000 of interest. Even though the rates are the same, you come out way ahead. Why? Because the principal increases each year due to the interest earned. So each subsequent year, the interest calculation increases as well on an ever-growing amount of principal. So you look at a summary here, your net gain is $118,000. But plus, you still have the $50,000 of principal because you never transferred that away in order to pay cash for this purchase. So the final balance is almost $215,000. And guys, that's just a small example of $50,000. Imagine if you put real money into one of these policies. Imagine if you put $500,000 into one of these policies, right? We're talking about huge wealth potential over time. And you can use it for whatever you want. You can finance lifestyle purchases like cars or boats, but you could also use it as down payments to acquire rental real estate. You could use it to buy into the stock market and kind of time the market when the market goes down. Again, you're taking back control of your money, growing your capital safely, and taking back control of that banking function in your life to give you more opportunity. Now, when you're looking at different ways to build your cash reserves or equity for infinite banking, you really have to look at 4 key characteristics. Number 1 would be how safe is the account or asset. Number 2 would be how liquid is the account or asset. What's the guaranteed rate of return? And then how is the asset taxed, right? Because there are different accounts that you can use for infinite banking. And this is a question that we get all the time. So when we look at capital reserve strategy accounts, I mean, you could borrow against a savings account or a CD. You could borrow against a qualified account like an employer-sponsored 401k. There's different assets, right? You could borrow against your stock portfolio using margin loans. You could borrow against your home equity using a home equity line of credit. But the preferred way is by using cash value life insurance, right? And we'll talk a little bit more about that when we kind of get to the end, because people ask, like, why is life insurance the best, right? But as we kind of shown, like looking at all these different charts and the way that the math works out, you can see the math works for itself, right? So a lot of people says this sounds fantastic, but it actually sounds too good to be true. So what's the catch, right? That's the key, is what's the catch? Well, when you think about what's the catch, there are actually three catches. Three. So let's talk about them. Number one is, at the end of the day, this is life insurance, which means being healthy is a big plus to this strategy. You have to be able to qualify for the insurance at reasonable rates. Now, if you watching this, if you're not super healthy, there are kind of ways you can do a workaround. For example, we have a lot of people, like if they're not healthy, they simply put the policy on their spouse, right? Like they can own it and control it, but they're kind of borrowing their spouse's life for the insurance, right? You can't just do this with a stranger, though. There has to be an insurable interest, like a spouse or a business partner, okay? Catch number two, you must capitalize your policy before you borrow against its value. Just as if you were starting a brick and mortar bank, or just as if you were building your own business. It takes a few years to get it up and running. Just like with the life insurance policy, it takes a few years to accumulate and build the capital reserves. I mentioned it earlier. This is not a gimmick. It's not a get rich quick scheme. It's somewhat similar to building equity in your home. It can take a few years. Now, with the way that we engineer and design these policies, we're able to build equity pretty quickly. So if you're able to put a decent amount of money into your policy, a lot of my folks will borrow against it in their first year. But you just want to make sure that you're not thinking of this like a get rich quick scheme. And then catch number three is this. The government actually limits how much you can put into these policies based on the underlying death benefit. So to maximize these policies, we do have to minimize the death benefit. And the reason we do that is to minimize all of the internal costs and fees, because that like drags down the performance of your cash value. But we can't minimize the death benefit too much, because within the tax code, they say like there has to be a certain amount of death benefit in relation to the cash value in order for it to maintain its status as a life insurance policy and maintain all of the tax benefits, right? So we need to make sure that it's structured just right and that it's still classified as a life insurance policy. And that's where, you know, everyone's going to be different. Like every infinite banking policy is going to look different, but you want to work with an infinite banking expert like myself, who knows how to design these policies properly, who have used them in their own lives like we do at the Sneller family, and have also helped many, many clients. Now, with the infinite banking policies, everyone's going to be different. Everyone is unique. Their goals are different. They have different ages, different time horizons. They're putting in money in different ways. Some people like to load it up in the beginning in 5, 6, 7 years. Some people make smaller monthly payments over the course of 30 years. So no two IBC programs will look the same. And again, that's where working with a specialist like myself is going to be super duper important. Next slide. What is the cost to do this? Now, that's really the secret to making the life insurance policy work properly. It's to structure the contract, to stuff as much cash into the contract as possible while minimizing the fees and the charges that typically come with insurance. Now, over the lifetime of the contract, those fees and charges and expenses are generally going to total about 1% of the total cash value that you've accumulated. Now, remember, the reason that we're using life insurance for infinite banking really doesn't have much to do with the life insurance at all. The two main things is, number one, the flexibility and guaranteed access to this line of credit that we're building through the cash value. And then number two, how the tax code treats life insurance. There's actually a very famous CPA named Ed Slott who has famously said that life insurance is the single greatest benefit in the entire U.S. tax code. Now, the life insurance, like the death benefit itself, is a nice added benefit if, God forbid, something happens to you, especially if you have a family. And of course, it can be great for wealth transfer later on in life for like estate planning and things of that nature. But the other thing, too, is if you pass away with an outstanding loan, that life insurance benefit will wipe out the loan for you, so your family's not responsible for it. And then your family will get any remaining death benefit that's left, right? So even if you have plenty of life insurance through work, like the group term that doesn't carry a cash value, or even if you're not married or don't have kids, this policy is still really practical because of those reasons, like using it as an asset where we can access the equity, and also because of the tax benefits. So we have the ability, along with our preferred life insurance partner companies, to create for our clients their own personal economy built upon a secure financial foundation, which is all built upon sound economic principles. And again, guys, we're not talking about long-term investing for 30 years down the road like you're doing with your 401k. We're talking about a strategy that's going to put you back in control by giving you liquidity and utilization of that equity. That's what that acronym right there, get a clue, I'm getting tongue tied. Control, liquidity, utilization, and equity. And it's really all about the way that we strategically manage these policies, moving your money and creating velocity, utilizing that equity to acquire productive assets. Really, that velocity gives us all the advantage because we're essentially able to create more with the same dollar. Because we're not interrupting the compounding potential of our savings. We're still getting 5 to 6% there, but we're leveraging the policy to potentially acquire other assets like businesses, stocks, real estate, things of that nature. So it's really kind of like that money multiplier effect. And at the end of the day, there really is no magic to creating wealth. Wealth is created through, number one, disciplined savings. Number two, uninterrupted compound interest. And then number three, the ease of leverage and the acquisition of productive assets. So the infinite banking policy, along with the utilization of high cash value life insurance, will give you the best opportunity to compound your savings with guaranteed principal protection, because that's important. We don't want to take risk with our infinite banking policy. So compound your savings, guaranteed principal protection, and guaranteed access to that capital in order to take advantage of investment opportunities and maximize your wealth creation. So with the infinite banking strategy, we're able to be flexible. We're able to utilize the tax-free guidelines within the Internal Revenue Code. We're able to grow our wealth off the radar of the IRS for income tax purposes and to create a tax-free retirement income. And then, of course, our most important promise is to secure the next generation. Now, I'm not saying that you should put every cent that you have into one of these programs, although I have a couple clients who do, and they're happy to do so. But what I am saying is that with infinite banking, it might be the first brick that you lay as you build your financial foundation, a foundation that will allow you to create your own personal economy, hold on to more of your wealth, and optimize the efficiency of all of your other assets within your investment portfolio. Guys, I have never had more fun in my entire career than I'm having right now by educating people on how to take back control of the banking function in their life by taking back control from the IRS and from their complete dependence on Wall Street too. We're able to position you and your personal economy where you can enjoy most of your money today, but at the same time, still save it for tomorrow. So if you want to know more about this and you're serious about learning and implementing the strategy, you can click the link in the chat box. My assistant, Ashlyn, she's going to put in a link to our Calendly app right there. And so you can just use Calendly. It's just a scheduling tool that allows you to just kind of pick and choose whatever date and time works the best for you, where you're able to schedule your own consultation. And you can do that, and I'll look forward to speaking with you guys. And I am going to click out of this right here because that's kind of like the end of the slideshow there. So let's take some Q&A. Ashlyn, I see a couple coming in here. Okay. Number one is, how would I actually initiate a loan against a policy? Very, very common question. And it's very simple. You contact our office because when we set you up with the infinite banking policies and strategy, like this family bank dynamic, we don't just set you up and sell you the policy and say, all right, have a nice life, see you later. Like, we're using, or the clients are using us as a tool and as a resource to manage and help them and coach them through this. So the first thing they do, they call us and say, hey, Ron, I want to take out a loan for $50,000, whatever the case is. And it's very, very easy. Again, we're talking about becoming your own bank. So there are no credit checks. There are no loan applications. They don't look at your tax returns. They don't ask you to send over your bank statements. All of that is eliminated, like when you would go to get traditional financing. All the insurance company does, they look at your account and they say, all right, you've got $70,000. Typically, they'll let you borrow up to 90% loan to value. And we just fill out the form. We send it to you. All you got to do is sign it in one spot. And a lot of times the companies want you to attach a void check. They just want to, make sure and confirm they're putting the money in the right account. We just send it to the insurance company, and usually within 3 to 5 business days, they just deposit that loan right into your bank account. So it's super, super duper easy. What's the next one? How do you actually pay the loan back? Okay, another really good one, guys. Again, when we talk about becoming your own bank, you're taking back control, meaning you don't have any required repayment plans. Now, a lot of times when I say that, people hear what they want to hear and they say, oh, Ron said I never have to pay my policy back. Well, technically you don't, but you should, right? Like if you're going to use this strategy to become your own banker strategy, you want to be an honest banker, meaning you want to pay yourself back on time and with interest. Now, what does on time mean? That's something that you and I discuss. You might take out a $50,000 loan to buy a vehicle, and you might want to pay it back over the course of 4 years. And I'll look and say, all right, the insurance company's charging 5% interest. We run a loan amortization calculator. We calculate your payment. Maybe it's $700 or whatever, right? I'm just throwing out an example. And you just pay $700 back. Like we can make it automated where they just attach it to whatever your premium payment is. So it's like you're paying your premium and you're paying your loan payment together. You can automate it if you want. Some people go in there and pay it manually. But the thing is, when you set up this loan repayment, it's nothing that we formally file with the insurance company, meaning that you're not held to it. And that could be helpful, right? Like you might be paying back your loan and then something happens. You get laid off of work. You have, I don't know, medical expenses come up that you weren't expecting, or something happens with the house. You need to get a new roof. You weren't expecting it. You could take a couple months off of paying back your policy loan, handle these other expenses, and then get back to paying your policy loan. Now try doing that with a traditional bank loan where you don't pay for your vehicle for 3 or 4 months just because something else came up. You know, it's like, here comes the repo man, right? Like say goodbye to the car, say goodbye to the house, whatever the case might be. So infinite banking, this process of becoming your own banker, it really gives you control. Now that's a double-edged sword though, because a lot of people unfortunately will abuse that flexibility and then not pay their interest. And then the insurance company, they start deducting interest from your cash value. So things can start going backward. We don't want that, right? That's why, again, as a coach and as your advisor, like we communicate, we need to make sure that the policy is working the way we want it to, including loan repayment. And if something changes, whether you want to accelerate the loan repayment or whether you want to slow it down or whether you need to skip a couple months, we just want to formulate a strategy so we make sure that things are happening correctly. Okay. What else do we have? Why life insurance? Isn't there other assets you could use? Oh yeah, I put that up on the screen and then I touched on it like just briefly. I meant to circle back on it, but yeah, there's different assets you could use. You could borrow against your 401k. You could borrow against real estate. You could borrow against your stock portfolio. It doesn't have to be life insurance. There are a lot of assets that could kind of work with the infinite banking strategy, but life insurance is the best. And there's really four reasons why, right? Like one of them would be this control that we're talking about. Like let's say that you borrowed against your 401k. The 401k max loan is $50,000, right? It's actually 50% of your account balance or $50,000 max. So if you have 50,000 in your 401k, you could only borrow half of that, which would be 25. If you have 500,000 in your 401k, you could only borrow 50, right? So it's 50% up to a maximum of 50,000, right? And when that happens, it has to be paid back within 5 years. And they take that out of every paycheck. And there's very, very little flexibility. Like it's a forced repayment back to your 401k, right? And when that happens, the other thing too, is if you borrow against your 401k, because the 401ks are generally invested in securities that are volatile or variable, there's risk there, right? And they don't want any risk on that. So what they do is they actually sell your securities, set your money in a side account, like just with cash. So it's not participating in stock market growth anymore. So there's a lot of downsides. I'm not saying like you're a dummy if you've had to borrow against your 401k in the past. It's just not optimal for infinite banking. Kind of same thing. Like you could have like a non-retirement account where you invest in stocks. You could have a certain amount of stocks in there, right? And you could borrow against that. And that has a lot more flexibility and control. The big problem there though, is the market risk, right? Because your stocks are securities and your bonds are securities. And when they drop in value, you can get margin called, right? Because again, they want to see the lender wants to see a certain loan to value for safety. And if we have a recession or a stock market crash and those stocks drop, they're going to do a margin call. And if you can't pay it back right away, they start force liquidating your stocks in order to raise the cash to pay the loan down and keep that loan to value where they want to see it within what they consider a safe range, so to speak. And if you have to like force liquidate stocks at a loss, you're just accelerating the downward spiral. That's the exact opposite that you want to do when it comes to stock market investing, right? So there's a lot of risk on that, and I just wouldn't take that risk. Other things, real estate. I mean, real estate's actually a pretty good one. I've done that before, borrowed against real estate. Maybe some of you watching have done that as well. I would say other than life insurance, this one maybe works the best. Just the problem is like, even when you set up that line of credit, once it's established, it's usually, usually pretty easy, but initially you have to go through that loan process, right? You need an appraisal, you need a credit check, you need to send over tax returns and bank statements, all of that. And even after all that, if they don't like what they see, like they can decline you, right? And the other thing too is that usually margin loans, because it's riskier, real estate loans, because they're riskier, usually those interest rates are going to be a lot higher than what you can get on life insurance. Like right now, most life insurance companies, even though we're in a pretty high interest rate environment compared to where we were 5 years ago, most life insurance loans right now are 5 to 5.5%. I'm seeing like 30-year mortgages at 7. I'm seeing a lot of HELOCs up at 7, 8, 9%. Depending on the company, like I've seen a lot of margin loans 8, 10%, like, into the double digits and more. So for all those reasons, that's why life insurance is the best. It's the safest, has pretty low interest rates, it has the easiest access. The insurance company never has to do an appraisal because they know exactly what your value is. They also know that your value can never drop due to a market decline, but also all the tax advantages on this stuff, because like I said, CPA Ed Slott has said that life insurance is the single greatest advantage in the entire US tax code, right? So as long as your policy is, number one, structured properly, so where it's not a mech, and number two, we're accessing the money properly, meaning that we're borrowing against it instead of withdrawing it. As long as we're doing everything correctly and working with me, I'll make sure that happens. As long as everything's set up correctly, once the money goes into the policy, it's never subject to income tax ever again. Really, it's never subject to any kind of tax, no capital gains. So that means the money can grow tax-free. You can access it tax-free. When you get older, you can turn it into a supplemental retirement income. So a lot of people will use this, like add this to their plan and use it like as a life insurance retirement plan, because the retirement distributions are also tax-free. And then when you die, the remaining cash value blossoms up into the much larger death benefit. And then the death benefit transfers to your family, and that's all tax-free as well. So just wonderful stuff here from like a taxation standpoint as well. Ashlyn, we took a bunch of questions here. Do we have anything else? Oh, Heather asked, will a replay be available? And would you say that borrowing from your policy and repaying it during early capitalization years is actually more advantageous than not? Yes, a replay will be available. So we'll record this so we can send it to anybody who wants it. In fact, Ashlyn, if you want to pop yourself up here, I believe that if you have the registration link, when you come back later and click the registration link, it'll automatically give you a recorded version. Is that correct? You can watch it again on demand. Okay, we can't hear you, Ashlyn. I think you're muted.
Yeah, right after the webinar is over, you'll get an email and it will send you the link straight to the recording.
Perfect. So if you click on the webinar link again, you'll just automatically get it on demand?
Yes.
Awesome. Okay, cool. Thank you.
Yeah.
All right, next question. Would you say that borrowing from your policy and repaying it during the early capitalization years is actually more advantageous than not? And I would say yes, because we have several policies where we're still in the capitalization period. Some of them are like heavily funding and we're going to do it for like 7 to 10 years. And some of them we're planning on doing it for all of our lives until we retire and use it as a bank, but also as tax advantage retirement income. But we borrow against our policies for everything. I don't know, Heather, if we're connected on social media. I just bought a new Escalade about 2 weeks ago. We just had a new baby. We need a bigger car. I did not finance it through the bank. We financed it through one of the policies, and we're still funding it. Just if you're doing that, you have to look at it like, hey, we need to still be able to afford the premium and make the loan repayment, right? So it's very similar. Like if you took a home equity line of credit, you'd have to make sure that you're paying your main mortgage and the line of credit, right? So you just got to make sure that it's going to work within your budget. But at the end of the day, like, where do I want that money going? When I make that car payment, right? Do I want that money leaving my personal economy and going to Chase Bank or Huntington Bank? Or would I rather borrow against my asset where the equity's already been built? You can only do it if you've already built the equity, obviously. But would I rather borrow against my asset and flow all those payments back into the policy, right? Because when you make payments back to your policy, what you're doing is you're paying down a line of credit. So every payment that goes in, it becomes immediately accessible to you again if you need to pull it right back out the next month for something else. And that's where you get into this dynamic for when you recycle your money. Really good question. Again, just like anything else, if you're going to borrow against your policy, you want to make sure that you're able to put together a loan repayment period that works right for you and that you can stick to it, right? Now, there's some flexibility if life happens. I know during COVID, we had a small outstanding policy loan against one of ours. I want to say it was like $10,000 because we were getting ready to move into a new house. We made some fixes on our old house, but we actually kept it as a rental. And then we moved, and it was at the end of 2019. And then a few months later, COVID hit. And there was a lot of uncertainty as far as what would happen with my business and my incomes. So for probably 6 or 8 months, I didn't pay anything back on that policy. And thankfully we did fine during COVID, and we transitioned to doing a lot of stuff on social media. And then when we got through it, then I started paying it back. I might've paid it back all at once. This is 6 years ago now. Because the policy loan wasn't that big. It was just something to do a little real estate repair. But again, you have that flexibility if life does throw you a curveball. Yeah. Do we have anything else, Ashlyn? Other questions? These are all really good. And then I would say again, guys, if you're interested in learning more, like Heather, I know that you're already a client. I believe that you guys have several policies, and you may want to start additional in the future, which is great. But for those of you who are looking to like review what you have or potentially get something started, best thing to do, and I know one of our other gentlemen who's in here watching, he's already a client on the investment side. He's got an appointment actually booked this afternoon to look at some of this stuff too, for not just him, but also his one of his kids. But the best thing to do is I'll have Ashlyn make sure she puts the calendar link for a discovery call in the live stream again. You can always use the link. And I also believe this video may be broadcast to social media too. So if you're on my social media, you can always go to the main link, whether it's TikTok, Instagram, Facebook. I always have like a link to my website or a link to my calendar. And you can use our Calendly tool, which will just allow you to see all of our availability over the next 2 weeks. So that's what Ashlyn's going to post in the stream. You could just click on that link, look at the availability. It'll set you up automatically with a Zoom call. It'll send you the Zoom link, and all you need to do is just, be there at that time. Now, once you book the appointment, Peyton from my office, she'll reach out and kind of let you know, like make sure the link came through and let you know what to expect or what information that you need to make the most of our time together on that first meeting. But yeah, really, really good stuff. Ashlyn, do we have any other questions or anything else? All right, very good. I'm trying to think. We answered a lot of good questions. I'm trying to think off the top of my head. Is there anything else that people ask about infinite banking? Just one of the things sometimes people want to do is they want to borrow against their policy early, and they're planning on doing like a monthly premium of, let's say, like $500 a month or $1,000 a month. But what some of those people will do is they will front load their policy and jumpstart it. I had one gentleman 4 or 5 years ago who front loaded his policy, like in addition to his monthly payment, because he was about to buy, it was like a used BMW, I believe. And I want to say it was like $25,000. It was older, a used one, but really nice. And so we found it, thought it was a great deal. He was about to pay cash for it. But when he kind of had learned about this structure, he's like, well, if I can put it in the policy first, 30 days after the policy loan, I can bring it, or 30 days after the policy is registered, I can bring the majority of that back out, make the car payment, and then just attach the car payment together with my premium payment, and then put both of those things back into my policy. And so that's what he did. So generally speaking, like once your policy is started, you can borrow against it at the 30-day mark. But depending on how much money you put in, like you got to like maybe not get your hopes up. Like if you're just making monthly payments, there's not going to be much, if anything, there at the 30-day mark. But I also have some heavy hitters that are like business owners, real estate developers. They pay annually. They put in $100,000 annually for their annual payment. And then 30 days later, they were able to pull out 75 grand. They were able to pull out 75% of it 30 days later, but that's because they front loaded a big amount in, and that was their annual payment. So again, there's different ways, and that's where you want to work with a specialist like myself to look at your time horizon, your resources, how much you can afford, because I don't want to oversell you and overextend you to where every month or every year you're cursing my name when that money has to go into the policy because you just can't afford it. Right. But it should get you out. It should get you out of your comfort zone, though, a little bit. Right. Like any progress that you make in life, it requires being a little bit uncomfortable, but not overly so. Right. So again, that's just, we work together to find out, like, number one, is it a good fit for you? Number two, make sure you know how it works. Then number three, how are we going to utilize it? How are we going to implement it? And then go from there. And then we help you over time. All right, great, guys. It looks like we got all the questions, so I really appreciate you taking your time. Hope this was helpful. And again, if you ever need any help with this stuff, reach out to me here, Ron at Sneller Financial. See ya.